What is an external audit? An external audit is where an independent CPA firm evaluates financial statements to ensure they're an accurate representation of the transactions that occurred during the fiscal year. Internal controls' existence and effectiveness are also reviewed. The CPA firm performs its audit in accordance with government auditing standards and provides an opinion on whether management complied with Generally Accepted Accounting Principles, or GAAP. Generally Accepted Government Auditing Standards, GAGAS, commonly referred to as the Yellow Book, are published by the U.S. Government Accountability Office, or GAO. The Governmental Accounting Standards Board, or GASB, is the organization that establishes GAAP for state and local governments. Preparation for the annual external audit begins before even the first day of the fiscal year. Because management is responsible for the preparation of the financial statements, they are responsible to properly account for the entity's transactions. We recommend that management has access to an individual who has a bachelor's degree in accounting. A CPA is preferable. This individual needs to understand GAAP requirements and comply with them, including keeping informed of new accounting standards and pronouncements. Remember, the audit is an evaluation and independent opinion of management's financial report and internal controls. Management should also have an understanding of internal controls, especially as established in the COSO report Internal Control Integrated Framework. Management should be able to design, implement, monitor, and enforce internal controls. An internal control is a process designed to provide reasonable assurance regarding operational effectiveness and efficiency, reliability of financial reporting, and statutory and regulatory compliance. Put another way, internal controls are an interlocking set of activities layered onto normal operating procedures to safeguard assets, minimize errors, and ensure operations are conducted appropriately. Examples of internal controls include separation of duties, physical controls, reconciliations, IT controls, and transaction and activity reviews. If management cannot comply with GAAP and achieve internal control objectives, the governing body should prioritize areas of concern, provide for adequate training, or hire qualified and competent personnel. During the fiscal year, management should ensure the 5 key components of COSO's internal control framework are functioning: a proper control environment, adequate risk assessment, effective control activities, clearly defined information and communication, and crucial monitoring activities. Management should also ensure compliance with state and federal law, federal grant requirements, including single audit compliance, lease contracts, and bond covenants. Management should correct any previous year's audit findings during the current year. Management should also document everything. The entity may know a review or process occurred, but without supporting documentation, the auditor won't be able to confirm it happened. Retain all supporting documentation for unusual transactions or unique circumstances, and ensure all files are well organized, complete, and guidance from a granting agency or other external source is retained. Many audit findings would be eliminated if the auditee maintained proper supporting documentation for transactions selected for testing during the audit. Before the engagement, management should prepare the following information: final trial balance. Every line item on the trial balance should have supporting documentation to support the number management wants in its financial statements. Complete general ledger. Cash or bank reconciliations. In order for the auditor to have confidence in the balances shown on the trial balance, all cash accounts should be reconciled. See the local Gov Resource Center for more information on reconciling bank accounts. Accounts receivable and accounts payable aging reports. A common audit finding is significant adjustments to receivables and payables accounts. Entities can prepare for an audit by reviewing their revenues and expenditures after their year-end to make the necessary accruals or adjustments. This practice is commonly referred to as a search for unrecorded liabilities. Prepaid expenses and fixed assets list. Entities should track any fixed asset purchases and disposals, as well as take an inventory of assets at year-end. The fixed asset inventory should tie to the amount listed in the trial balance. Inventory list and inventory shipment receipt records. If the entity uses inventory, the inventory should be counted at year-end and tied out to the trial balance. Voucher approvals. The entity should document and provide approvals for payments, credits, and voided transactions. revenue detail by customer and by invoice, with any deferred revenue listed and the deferred revenue detail. Payroll register. The entity should prepare a payroll register as well as supporting documentation for all payroll liabilities recorded on the trial balance. A common finding comes from payroll liabilities that are accrued in one GL account and paid out of another. Reviewing these accounts prior to the audit will improve financial reporting and help the entity avoid audit findings. Entity structure documents, debt agreements, bond covenants, lease contracts, and other important contracts, and governing body minutes. Remember, management needs to prepare these documents before the auditor arrives at the entity.